we need to ask ourselves if the low is behind us and stocks could continue to move up, up and away. My name's Jessica Amir, a market strategist here with Mehmet. It's great to have your company this 15th day of April. Well, we're seeing US stocks charge up off their lows. If we look at the NASDAQ 100, it's now up 14%, up off its April 7 lows. Hallelujah. The Aussie share market is now up 5.5% from its bear market bottom. And why is that? Well, it's because volatility is dropping like a stone. The volatility index, which we track on Moomoo via the VIX, that's fallen from its max COVID hysteria levels of 60 that we saw on April 7. And now the volatility index is at a level of 30. But after analysing the last significant sell-off, say the Japanese carry trade, July last year, we saw the VIX fall from its peak uncomfortable level down to 30, and we're back at this level again, 30. And this is typically a level that allows investors to, catch their breath, and that's why we're seeing stocks move to new highs. That happened last year, and it looks like it could be happening again. So while Trump continues negotiations and explores some tariff exemptions, and we do have most companies that are reported so far, albeit 30 of the S&P 500 companies have reported results so far, they've mostly been better than expected. So this is a sweet set of ingredients that allows investors to feel encouraged to buy, while we're particularly seeing the safe havens, the US dollar and bond yields, continue to fall. So this is why investors are feeling a little bit more confident and they're tiptoeing back into shares and buying. And remember, like we said yesterday, bets via the options market, essentially sophisticated traders are betting that the market will move higher by Thursday, the 17th. Well, now those bets suggest that market rally could continue and the market will be 1.1% higher by Thursday, the 17th. So it seems that investors may probably be rewarded when they're buying the dip and taking a long-term view, but focusing on quality stocks and being stock specific. I think we've got to remember, sure, we're not out of the woods yet. US President Donald Trump is exploring semiconductor and pharmaceutical import tariffs. But on the other hand, he's considering exempting tariffs on imported vehicles and parts, because that'll give car makers some time to essentially set up shop or manufacturing in the US. So that's the cautionary tale. But we do have some good news starting to pick up as well. Fed speakers, they're now saying tariff inflation is probably going to be transitory. So the market, hallelujah, is now expecting US interest rates to be cut by 1% this year. All in all, despite the murkiness and the uncertainty, we do have a good setup for stocks and gold if you take a long-term view. The trick is to turn down the noise, ride out the volatility perhaps, and look at buying quality stocks. Let's have a look at one stock in particular, Microsoft. So last week we spoke about them in our weekly on Friday, and I said that Microsoft has got a history of bouncing out of bear markets the quickest. So let's have a look at Microsoft now. Microsoft shares are up 12% from their lows. They're still down in a correction, 13% from that high that we can see toward the left-hand side of the screen. So they're still down in a correction. But remember, as we said on Friday, in the first trade war induced by Trump, it was actually in 2018, Microsoft fell 18.5% from peak to trough, and then they strongly rebounded 44% to a brand new record all-time high after just 1.8 months. So encourage you to think about watching Microsoft, remembering that they are deemed a quality company, and they are in most quality ETFs around the world. So that's why stocks like this, will be bought when fund managers are rebalancing their portfolios and ETFs are rebalancing their portfolios, because this is one of the most quality companies in the world. A lot of their revenue comes from subscription models. So watch their April 30 results. Yes, we know they've already abandoned their $1 billion data center project, so they're cutting costs, but you might be seeing their rally continue. What else do you need to know? Well, today's setup for stocks looks particularly positive for local tech stocks and for commodities, and that's because the US dollar is continuing to fall. Also think about those commodities that might be benefactors and needed in electronics and cars if we see reprieval there from tariffs. Now, the futures were earlier suggesting the Aussie market would slightly nudge up by about 0.2% and get closer to 7,800 points. But do focus on those auto parts businesses that could get some reprieve. So here's a reminder to perhaps look at ARB. Now, ARB is a company to watch. It's still down 36% from its record all-time high that it hit last year in September, but it's moving up fast. It's up 11% up off its lows. And I think investors will probably be buying the dip, believing potentially that we could see strong earnings growth. And if estimates are correct, we could see their earnings grow at 23%, and profit growth could hit a record all-time high this year, and profits could be growing at 58%. And maybe we could see profits at $428 million by the year ending 30 June. And that would be a record all-time high. So there's a lot to be said when Trump does give a reprieve on auto parts businesses. If this comes to fruition, AIB would be a key company to watch. So much to watch and consider. It's great to have your company for the daily. Stay safe. Happy trading. We'll see you tomorrow.